Welcome to Course 04 of the MaxLife Commercial Academy, Financial Analysis for Commercial Real Estate. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC, license number 3354351 here in Central Florida. In this course, we're going to go deep on the financial models that separate serious investors from everyone else. Discounted cash flow, NPV, IRR, MIRR, the capital stack, and more. By the end, you'll be able to build a 10-year DCF, calculate every major return metric, and compare two deals head-to-head using the exact same framework institutional buyers use. Let's get into it. Everything in commercial real estate finance, every cap rate, every IRR, every DCF comes back to one bedrock idea, the time value of money. The concept is simple. If I offered to give you $1,000 today or $1,000 3 years from now, you'd take today's money without thinking twice, and you'd be right to. Today's dollar can go to work immediately, earning rent, paying down debt, or sitting in a treasury earning interest. 3 years from now, the same nominal dollar has lost ground to inflation and missed 3 years of compounding. When we talk about present value, we're asking, what is a future cash flow actually worth right now, given a specific discount rate? When we talk about future value, we're asking the reverse. If I invest today's dollars at a known rate, what do I end up with? The discount rate is the critical input. And in commercial real estate, it is almost always the investor's required rate of return, the minimum return they need to justify the risk of the deal. Every single valuation model you'll encounter, from a basic income capitalization to a full institutional DCF, is just this arithmetic applied repeatedly across a timeline. Get comfortable here, and everything else in this course will click into place. The discounted cash flow model is the single most important valuation tool in commercial real estate, and it's nothing more than the time value of money applied across a full hold period. Here's how it works. On the input side, you build a year-by-year projection of the property's net operating income, typically over a 10-year hold. You layer in your assumptions, a rent growth rate, usually 2 to 3% annually, vacancy and credit loss, capital expenditure reserves for the roof, the parking lot, tenant improvements, and finally a terminal value, also called the reversion, which is what you expect to sell the property for at the end of the hold. That reversion is usually calculated by applying an assumed exit cap rate to the projected year 11 NOI. Now the output side. You take each year's cash flow and discount it back to today's dollars using your required rate of return. You discount the reversion the same way. Add up every discounted cash flow plus the discounted sale proceeds, and you get the indicated value, the maximum you can pay today, and still hit your target return. From there, you build a sensitivity table showing how that value swings as your discount rate and exit cap assumptions change, and you solve for the IRR and equity multiple at any given purchase price. The entire formula is right here on screen. Value equals the sum of each year's NOI divided by 1, plus the discount rate raised to that year, plus the reversion discounted back over the full hold. Master this one equation, and you can value any income-producing property on Earth. Net present value and internal rate of return are the two most important return metrics in commercial real estate, and they're deeply related. Both are built from the same discounted cash flow math. They just answer different questions. NPV asks, given my required return, does this deal create or destroy wealth? You take every projected cash flow, discount each one back to today's dollars at your hurdle rate, add them all up, including the eventual sale proceeds, and subtract the purchase price. If the result is positive, the deal creates value at your required return. If it's negative, you're paying too much for the risk level. IRR flips the question around. Instead of assuming a discount rate and solving for NPV, IRR solves for the rate that makes NPV equal to 0. That rate is the deal's internal rate of return, the annualized yield the investment produces across the entire hold period. In practice, institutional buyers set a hurdle rate, the minimum IRR required given the deal's risk profile, and then reject any deal where the projected IRR falls below that threshold. Core stabilized assets might have a 7% hurdle. Value add deals typically need to clear 14 to 16%. The important thing is to always use both metrics together. IRR doesn't tell you how many dollars you're making. NPV doesn't tell you how efficiently your capital is working. Together, they give you the full picture. IRR is the most widely quoted return metric in commercial real estate, but it carries a hidden flaw that can seriously mislead you, and the modified internal rate of return, RER, is how sophisticated investors correct for it. Here's the problem. Standard IRR makes a silent, unrealistic assumption. It assumes that every interim cash flow the deal throws off, every quarterly distribution, gets reinvested at the IRR itself. So if a deal shows a 22% IRR, the math is quietly assuming you can take those distributions and redeploy them at 22% for the rest of the hold. In the real world, that almost never happens. Those distributions usually sit in a money market or get reinvested at a far more modest rate. The result is that IRR systematically overstates returns, especially on deals with large early distributions. Worse, when a deal's cash flows change sign more than once. Say you have a capital call partway through the hold, IRR can mathematically produce multiple valid answers, which is useless for decision making. MIRR fixes all of this by using two explicit honest rates. Positive cash flows are assumed to grow at a realistic reinvestment rate, typically your weighted average cost of capital or a safe rate around 6 to 8%. Negative cash flows are discounted at your financing rate. The formula on screen takes the future value of all the positive flows, divides by the present value of all the negative flows, and annualizes the result. MIRR always produces a single, unambiguous answer, and it's always more conservative and more accurate than standard IRR. When I'm underwriting a deal at MaxLife Commercial, I always look at both. If a sponsor is only showing you IRR, ask them for the MIRR. The gap between the two tells you how much of the projected return depends on reinvestment assumptions that may never materialize. Once you understand IRR and MIRR, you need the equity multiple, because IRR alone doesn't tell you how much money you actually made. The equity multiple is brutally simple. Total dollars returned divided by total dollars invested. If you put in $1 million and get back $2 million, you've got a 2.0x equity multiple. That's it. Now, where it gets interesting is when you layer debt on top. Unlevered returns reflect the deal's performance as if you paid all cash. No financing, no debt service. This is how you compare two deals with completely different capital structures on an apples to apples basis. Levered returns add debt into the picture, and here's the key insight. Debt is only your friend when it costs less than the deal earns. When your cap rate is higher than your loan constant, the all-in cost of servicing the debt as a percentage of the loan, you have positive leverage, and every dollar of debt you add boosts your equity return. When the loan constant exceeds the cap rate, debt is actually hurting you. In today's interest rate environment, this distinction matters enormously. Many deals that penciled at a 5 cap in 2020 with 3% debt are now experiencing negative leverage at the same cap rate with 7% financing. At MaxLife Commercial, that's one of the first things we stress test on any acquisition. You can reach me directly at 321-586-2121 if you want to work through a specific deal. The capital stack is the architecture of who owns a deal, who has priority when money flows in, and who bears the most risk. Think of it as a building. The most secure floors are at the bottom. The highest risk and highest reward is at the top. At the base is senior debt, a conventional bank loan or CMBS loan secured by a first mortgage on the property. Senior lenders get paid first, every month, before anyone else sees a dollar. Because their risk is lowest, their required return is lowest. Above senior debt, you might find mezzanine financing, a subordinate loan often used to bridge the gap between what a conventional lender will provide and what the deal needs. Mezzanine lenders aren't secured by the property directly. They hold a pledge of the equity interest instead. Because their position is riskier, they charge more, often in the 10 to 14% range. Above mezzanine, you have preferred equity, not technically debt, but structured to behave like it. Preferred equity investors receive a set return, typically 8 to 12%, before any common equity sees distributions. They don't participate in upside beyond that rate. Then, at the top of the stack, you have common equity split between the LP investors, the passive capital partners, and the GP, the sponsor who is actively managing the deal. The GP typically earns a promote or carried interest, a disproportionate share of profits above a hurdle return to compensate for deal sourcing, execution, and management. Understanding the full capital stack is essential whether you're a passive investor evaluating a syndication or a sponsor structuring your first deal. Now we put it all together. You have two deals in front of you and one pool of capital. This is exactly the situation you'll face in real life, and the math we've built in this course is what resolves it clearly. Deal A is a stabilized single-tenant NNN retail property. It's boring in the best possible way. A lease in place, a creditworthy tenant, minimal management required. At a 5.8% cap rate with 60% LTV fixed rate debt, the leverage is essentially neutral, so returns are driven almost entirely by the income stream and exit cap assumption. The DCF tells us we're looking at a 9.4% levered IRR and a 1.71x equity multiple over 10 years. NPV is positive at our hurdle rate. My IRR checks out. This is a core plus deal. Deal B is the opposite, a value add office conversion with a 4.2% going in cap and floating bridge debt. Day one cash flow doesn't cover the loan constant. This deal is burning equity until the business plan executes. But if it executes, if rents stabilize at pro forma and you exit at a 6% cap in year 5, the IRR clears 17%, the equity multiple hits 2.4x, and the NPV at your hurdle rate is more than double deal A's. The stress tests matter here. Run every scenario. What happens if exit cap rates expand by 100 basis points? What if the renovation takes 6 months longer than planned? What if floating rates spike another point? The deals that survive stress testing are the ones worth pursuing. This is the process. Not intuition, not gut feel, just math applied consistently. That's what we build at MaxLife Commercial. That's Course 04, Financial Analysis for Commercial Real Estate. And you now have the complete toolkit. You understand time value of money, you can build and interpret a discounted cash flow model. You know the difference between NPV and IRR and why MIRR often tells a truer story. And you can read a capital stack and understand exactly where your capital sits in the priority waterfall. The next course in the MaxLife Commercial Academy takes all of this and moves it into Excel. We'll build a live pro forma from a blank spreadsheet and model a real acquisition from first principles. If you have questions about anything covered here, or if you have a deal you'd like to run through this analysis together, reach out directly. I'm Ryan Solberg, real estate broker with MaxLife Realty LLC, license number 3354351. You can call or text me at 321-586-2121 or visit maxlifedevelopment.com/academy for the full course library. Thanks for investing the time to learn this material. See you in the next course.